Hey folks, welcome to Pro Trader Strategies. We are an educational company, so if you want an edge, it starts with education, folks. And hitting that subscribe button. There's also a little notifications down there, a little bell that you can click on. Make sure you click on that because I pop on every now and again, especially during earnings seasons, to talk about my trades. And those are going to be unannounced. So that way you'll get a notification and be able to jump right in. Also, comment throughout this video. I'm going to make sure that everybody a clear concept before we start moving on. I don't want anybody kind of worrying about asking a question throughout the video. You don't have to wait till the end during these videos, okay? So please make sure you are reaching out whenever you have a question because somebody else probably has that same question, folks. So please do it. And finally, smash that like button as it does really help us out. All right, folks, we are doing this video on the swing trades using options, all right? We've done some other ones. We're into a new section here. We've done the bullish moves and the bearish moves. Now we're going to be talking about how you can take advantage of an underlying that just isn't moving. So how do you do that? Well, we'll talk about different scenarios that you can implement this strategy around an underlying that you believe is going to be trending sideways or is in market neutral type of trading, just not really having any direction, or you just don't have a directional assumption. There is opportunities out there. I implement this a lot of times when I just really don't know, but all of the other levers and pulleys for this underlying are working out. So you just have to take advantage of it. That's another way to look at it when you don't have a directional move with this specific strategy, which is the Iron Condor. Let me throw on this one. All right, so we're going to be doing swing trades. Now we're doing the Iron Condor. Now, swing trades usually are we're trying to figure out when this underlying is starting to revert back to the mean or start to bounce off of a support or resistance. Now, we can do that with this trade as well. What I like to do is when this swing trade has kind of happened, what we see happen a lot of times is the underlying will move quite dramatically, right? And we're trying to catch it at those areas where they hit the support and resistance, whether it's a bullish move or not. Now, with this specific strategy in the Iron Condor, it's kind of like you've gotten this massive moves and now you're looking for it to kind of settle down just a little bit. That would be the timing for this type of trade. And that's what I'm going to talk about when we get to that point. But first off, let's talk about how you would really do a swing trade. And what is a swing trade specifically? Now, what I've said before is we have talked about when we are looking at a swing trade. Let me get my pen ready. Sorry, folks. We've talked about the bullish moves, right? We've had option strategies when we talked about the bullish moves and we see the underlying moving in a bullish pattern, but, back and forth. And we talked about the bearish ones where we've taken advantage of an underlying that is in a bearish trend, if you will, or in a bearish pattern. Now we're going to be looking at the ones that are just going to, we've seen them move and now they're kind of going to go like that is what we ultimately would like to see happen, whether it's going up or down. We just kind of want it to stay in and around this middling area. Normally with swing trades, we talk about you got the resistance, the support level, and then the pattern within the overall trend is what we're looking for most trades. If you're looking for a bullish move, you're looking for that pattern reversal here, or in a bearish move, you're looking for this type of pattern reversal after it's hit a resistance or bounce off of a support bullish move. You guys aren't seeing my screen. Is that true? Oh, we're not seeing my screen. No, I forgot to share it again. Thank you, Liana. So in the last ones, let me just review real quick. We talked about the bullish trades that we can take advantage of on a bullish pattern. This is ultimately what you're trying to do is note where resistance and support are for these and the pattern within that move. So you have to first go out and find, like I said, whoops. Oh, where am I at? I skipped forward too far. Sorry. So if you have an overall bearish trend, right, Then you're trying to then find the resistance support levels and then note what is happening. We're basing the trade off of the pattern, right? The pattern is within the overall trend there. And the reason why we want to do that is because when there's support and resistance areas, that is usually where a lot of people are coming in and buying. And then when it gets up against the resistance area, they feel like that's where, you know, the momentum starts slowing down because people are covering their trades that they made off that swing. And it will have a tendency to bump up against the support and resistance. And we can easily see that happen when we kind of glaze our eyes over an underlying. So if you squint your eyes here, even with all the other lines, you can see the underlyings going like this, right? I did that kind of bad, but you can ultimately see, well, there's a resistance area and there's support here, and it does pop through. So every once in a while, we will see something. What happens when we were talking about we've got a bullish trend, right? And we see something going like this, and we're trying to base it on the resistance and the support, right? And then we've got a pattern moving here. Well, sometimes the underlying will then kind of free fall and break down below here. But the thing to know with swing trades is we know that when it gets kind of overextended to these areas, it does want to snap back into that trend channel, okay? And we will see that it does that. Now, if you were involved in this swing trade with the underlying outright, like I went out there and bought 100 of the underlying for this swing trade, well, this move, when it makes that move to the downside, it flushes us out of that trade, right? If you were long, because all of a sudden it broke that resistance. Well, what we're going to be talking about is when we're doing option trades, we can get our strike location even further outside of those areas. So once you've identified those support and resistance areas, those are going to be key for implementing a trade around. But then if you have options around that, you're adding another layer of security with that because you're able to get better strike location. Now, you might not get dollar for dollar what the underlying is accruing. If the underlying starts rallying dollar for dollar on a 100 lot, you would gain for that dollar. Now, we aren't going to be playing with that type of movement. We're not going to gain or lose by a dollar up or down with this type of strategy. What we're going to be doing with the options is you take advantage of it. You won't profit as much as you would if you had the underlying, but your risk is much less. All right. So that's why we would want to use options, is relieve that risk that we would have in our portfolio normally. All right. So we've got this, right? Ultimately, what we want to do is find the overall trend, whether it's bullish, bearish, which we've done for the most part on trades. But now we're going to be looking at the ones that are going to be more market neutral, where they stay within a tight range, moving sideways. That would be the best way to take advantage of the strategy we're going to be talking about today. And then you identify these. This is the resistance. Resistance and support level, right? Along this line. And here, then finally, you look for the pattern within the overall trade. Now, with this trade, we're actually going to be looking at an underlying that comes back up right around that middle area, where it's usually pretty difficult to put a trade on around that, right? Because it's right in the middle of that range. There's no real strategies to put in and around that, because it could roll back down to the support, or it could move back up to the resistance area, right? So in that kind of case, this, when it's right in the middle, is what we're going to be looking for on this type of swing trade. Because usually when it's right there in the middle, it could go down. You've got basically a flip of a coin. It's going to go up or down at that point. All right. So that's why we want to use options, because you have better odds, better probabilities. I guess that's better probabilities is the same thing, and less capital, less risk. All right. That's why we want to use options, because you are limiting your risk most times, especially with this trade, you're going to use much less capital than going out and buying a 100 lot, right? Well, with that, you're also all those less risk, less capital, you're going to get less reward, but you have a higher probability of success. Does that make sense to everybody so far? I'll show you how we'll work these probabilities as we start going on a little bit further. All right, so ultimately, we've got this as a market neutral. Now, I wouldn't necessarily do an Iron Condor in when it's up and around these support and resistance area. This would be something you would look for to come back down to the point of control there. But, you know, I'm just trying to show you that when you're looking at these, you try and find these resistance areas, support levels. You know, you can do it a little bit tighter. I got mine a little bit wide. And that's where you're going to be looking for a trade like this when it gets back to in and around that middle of the road. Now, a lot of times for lower risk tolerant or newer traders, I say, you know, you enter in when it hits up against the resistance or the support level, and then you would get out in and around that middle area. You know, if you have a higher risk tolerant or you're a higher risk tolerant person, then I would wait for it to hit those extremes. But newer traders, to get used to getting in and out of these trades, you know, get in when it hits the extreme or the support and resistance area, get out when it hits right around that middle of the road. Now, how can we take advantage of one that is right there at the middle of the road? We're going to be looking at that for a strategy that will take advantage of a market neutral assumption. Actually, this is the trade that I want to look at with Delta. So you can see this is a pretty messy chart for the most part. We could say that, you know, this is a resistance area. I could say that this is a support area. But the one thing I want to note right here, this is not really the point of control. We've got a point of control down here for the time, or sorry, for the volume. This is the volume point of control. This is the point of control for time, all right, on this market profile on the side. Now, on the floor, we used to call this the Stoudemire, and it really gives you a great gauge of what the market is thinking for value in this underlying. And you can see there are three different areas where the market has found value, right? It's spent time up here. They haven't really transacted. Sorry, I keep hitting my thing on the side there. Let me change pens. So what happens is when it trades or it just sits there at that level, you get used to it. When you see a price always showing up, say right around 46, and it just seems like day after day after day, it's trading 46. Well, you don't have a whole lot of angst, right? If you got in, it's just like, I'm still sitting here. You're either up money or down money at that point, but if it's not really juking around, you're not really worried about covering it. But when it gets to extremes, you start thinking, man, I'm up a lot of money or I'm down a lot of money. I got to do something, right? So up here, it's just settling down. There's no transaction happening. Down here's where the transaction happens. So a lot of times what we see is right in between there is where we start building up another node. And I could easily see both of these nodes shift to this area right here. And that would really settle this underlying down quite a bit. So I'm kind of looking for Delta to trade right in and around this 41, 42 area, okay, for at least the next 2-3 weeks, okay? That's what I'm looking for in a trade for Delta Airlines right now. So why would we want to use, or well, let's talk a little bit more about options real quick. Just go over some real brief stuff for some of you folks that might be new to this. And when we're talking about options, usually it's from the buyer's perspective, okay? Because the buyer is the one that really is creating this contract, right? Because they want it. So a buyer of a call has the right, but not the obligation, okay? That means he doesn't have to, okay? Buy the stock. So when we're talking about strikes in the options, if XYZ is trading, let's just say 100, to keep it simple, the call, if somebody were to buy a call at the 105 strike, right? That means that whoever bought that 105 call has the right but not the obligation to buy XYZ at $105, right? If I buy the 105 call, that means I have the right but not the obligation to buy XYZ at 105. Now, if it's trading 100 right now, do I want to exercise my right to buy the stock at 105? No. Why would I want to buy it at 105 when it's trading 100? I can go out there and buy it at 100, right? But if XYZ goes up in value to say, let's just go crazy and say 200. Now I still have the right, but not the obligation to buy the stock at 105. Do I want to do that? Absolutely. There's an immense value in owning a 105 strike when it's trading 200. There's $95 of profit in there. And the options have to reflect that difference, okay? In the money options have to be at least, if not more valuable than that difference. So in this case, if I was talking about XYZ shot up to 200, that means that the price of those 105 calls is $95 and change. There's probably some other theta still left in there, maybe some volatility, also some other things that'll jack up that premium a little bit. All right, so the buyer has the right but not the obligation. Now the seller, on the other hand, has the obligation to fulfill the contract if the buyer says so. And if you take it into expiration, any in the money options get exercised, okay? If you have it in your account, in the money options will get exercised after expiration, after they expire. They'll send you the amount and it will go into your account at whatever strike price you had, okay? The seller has the obligation to deliver the stock. Now, if XYZ continue to trade around 100 and I was the seller of that call, I'm going to collect a premium for it. All right. Even though they're out of the money, I will collect a premium for it because there's time value still in there. There's still an opportunity for those options to go in the money. So there's some value there. All right. And if it went up to 200, I would have to give that gentleman or that lady my stock at 105. All right. I would not be able to participate on any of that upside. I'd get to keep that premium, whatever that premium was, still stays in my account. I get to keep that, but I have to deliver the stock. All right. And the put buyer, on the other hand, has the right but not the obligation to sell that stock. All right. So if you bought a put, say at the 95 strike, if I bought a put there, right, I have the right but not the obligation to sell XYZ stock at 95. Now, if it's trading 100, do I want to sell it at 95 below the market? No, I'd sell it at 100. But if the underlying fell out of bed and sold off to 50, right, and I had bought a put, I have the right but not the obligation to sell my stock. That means I can just say, hey, those are yours. You know, I'm out at 95, okay? And the put buyer would then have to buy it at that strike, okay? Or take delivery. He is having to buy it. He's going to have to buy it at whatever strike. Now, there are times where an out of the money option, some crazy dude comes out or somebody who doesn't know what they're doing comes out and says, yeah, I want to take my right to buy this stock, even though it's above where it's trading. It would be crazy, but those are good problems to have. All right. Now, I talked about option pricing. First thing you have to do before you start trading options, if there is one thing you need to know if these options are expensive or cheap, right? I mean, you don't just go out there and usually buy things without really knowing what the price is, right? I mean, we even do that with gasoline. We'll drive a mile to get gasoline 10 cents cheaper, right? So we are good stewards of our capital most times, if we know. And most people don't understand that there is a way to determine whether these premiums are expensive or cheap, okay? We can't tell by just looking at Delta Airlines and I can't just look at these pricings over here and say, oh my gosh, these are super cheap and these are super expensive. No, it doesn't work that way. What we need to do, though, is look at this Vega, all right? And that's just implied volatility. You'll see implied volatility in a lot of different places. They just named it Vega over here in the option montage to be cute, I guess. And what Vega tells us is the definition of Vega or implied volatility is for every 1 percentage point increase, everything's assumed to be an increase or moving forward with all of the Greeks, folks. So this is saying that if this number increases by 1 percentage point, I get 1 percentage point increase, okay, in this number. So now it's 50/18, right? That would mean that all of these corresponding numbers that are going to increase the premiums, all right? Every 1 percentage point increase, that corresponding coefficient will increase your premiums. It's 4 cents, all right? 1 percentage point increase, nothing else happens. My premiums are going to increase, all right? So this number is very important, not this number here, but that 49 is very important for Delta, not for Tesla. 49 might not mean anything for Tesla. What we need to do is compare apples to apples here with the options. And the only way to really do that is to look at Delta's implied volatility in relation to Delta's implied volatility in the past, okay? And the way we do that is basically through the charts. You can see down here, I have implied volatility as a chart because I want to track that. That's the only thing that tells me anywhere if options are expensive or cheap. Because as this number goes higher, right, if we know this number goes up, that means those premiums go up. And we can see that implied volatility for each underlying has a tendency to trade in a sideways pattern, kind of like what we're talking about with these swing trades. So you can kind of look at it and then determine where your support and resistances are. I would say that basically, I like to discount any of last year, right? Because that was kind of a crazy year. We saw volatility, the highest levels we've seen since the 80s, folks. I'm talking 80s, not the financial crisis, not 2000. None of that had the volatility like we've just seen in the pandemic. So I don't think that we're going to see that kind of volatility, because volatility is usually associated to unknown, and we've kind of got a pretty decent grasp maybe on this COVID. Definitely a lot better grasp on it than this time last year, right? So with that, we could assume the volatility is probably not going to get as high as last year. So I want to take that out of my data set. Now, a lot of the platforms will do the last 52 weeks, and we have the script, or I've got the script that does it for the last 6 months. All right. So I've even written the script to where it discounts that. So you don't even take it into account. So you want to say that's kind of like the resistance area, and your support level is going to be way down here. All right. So we can see that this premium at 50 is, or the volatility at 50 is relatively high. It's not at, the very highest level, but we know it's relatively high. And one thing about volatility is it has a tendency to go back to that mean. We've talked about with, your support and resistances, and then back to right around the mean. Well, that's kind of like what we do with options. Well, this one is kind of right there in the middle again. We've got a trade that's right in the middle, and we've got the volatility relatively in the middle, right around 50%. So I usually say when it's above 50%, we say that we want to sell. And when it's in that lower 50% down here, this is where you want to be buying options and selling options. All right. And right now we're kind of right in there in the middle where it's a bit of a pick 'em. Now, if I believe, if my theory is correct, where we're going to settle down right here, well, what happens when you start settling down? Well, that volatility goes out. Volatility is basically a gauge of how far this underlying is going to move. All right. And as the underlying starts settling down, the volatility starts settling down with it. And if volatility goes down, what happens to our premiums? I talked about if volatility goes up by 1 percentage point, our premiums increase. When volatility goes down, folks, our premiums decrease. even if the underlying doesn't move. Nothing else happens. The underlying stays there. The volatility goes down. Those premiums will go down. So if you really want to dig into this one, you can see we're right there at around 50. We could say that this high is around 65. The low is right around 35. And then this is 50. And like I said, I usually say you buy when it's down here and you sell when it's up here. Well, if I thought volatility was going to go up, I'd probably be buying it here on a toss-up. But I think the underlying is going to settle down. And usually when the underlyings start trading in a tighter range, that volatility starts coming out. And that's what I'm going to be looking for, is volatility to start coming out with my theory. So in that case, one other thing I want to talk about. If you really want to dig into the devil of the details, if you're a numbers person, you like to dig into this, the way you do it is you take the current implied volatility, IV, minus the low, IV. You take that sum and you divide it by the high, IV, minus the low, IV. And this is just basically the math to get where we currently are in relation to the entire range, right? Because this is our entire range. And basically we're finding out where the current is, from the bottom to here. So we're trying to find out where we are in that area. So if I took the current and we got 50 minus the low of 35, and I take the 65 minus the low of 35, I got 15 divided by, that's 35, 15 divided by 30. So that's basically 50%, right? So if you want to do the math, you can do it that way. If you want the script, reach out to us at Trading and Pro Trader Strategies. I got the script. We can send that to you because, like I said, the platform will add all of this in, okay? Which isn't really good for our data set. Why? Because the volatility just probably isn't going to go back up there for another 40 years. All right. So what do we determine? I'm going with that they're kind of expensive, so I want to sell them. I really believe that volatility is going to come out, so I am leaning towards that selling of options, all right? Now, if I want to sell options, because I've got that high volatility, I got high volatility, I want to sell options, I want to take advantage of that juicy premium they're giving me, then I still have to be thinking about I sell high and buy low. Well, I want to talk about Theta for a minute then. This is one of those other Greeks. Don't run away. I'm making this easy for you. Theta is the thief in the night. The easiest way to remember it. Theta is the thief. Vega is volatility, all right? Theta is the thief, though. And Theta comes and steals your premiums every single night in the options. You can't stop him. Every single night in the calls and the puts, he comes and picks your pocket, all right? But it's not linear. It's not like it happens evenly. All right, it's not $1, $1, $1. Really what starts happening is it starts out as maybe 50 cents or whatever. The next day, then it's $1, and then it's, $1.50, and then it's, $2, and then it's $2 and change. Okay, so it's ramping up the closer and closer we get to expiration. And at expiration, anything that is out of the money is basically worth nothing. All right. Because nobody wants to buy or sell options when they are at those extremes there, all right? All right. So what we can see here is it isn't linear, right? It actually even further out will start leveling off just a little bit even more, okay? So if you are inside of 35 days to expiration here, that is the sell zone. I actually will stretch it out. Most people will say right there, I usually will stretch it out maybe 45 days to expiration would be the extreme there. Get involved in there, and then you get this ramp up in Theta, all right? And then I usually like to get out right around 7 days to expiration. All of this, it just gets a little wanky. Yeah, you can squeeze it out, but with a trade like this, we're going to be far enough away from where the underlying is trading that this isn't going to be helping us at all. And then this is where you would be buying options or doing a debit spread anytime you're laying out a debit or paying out for something, then you want to be doing that out here to limit that theta decay, right? Because if I'm buying something and every night theta comes in and steals a couple of pennies from me, well, I want to limit it. Whereas if I'm out here outside of 70 days is usually what I'm looking at for buying, then I can limit that theta decay. You can see that if I get out here in 70 days, it doesn't really start ramping up. But if I got involved in a buy out here, 50 days to expiration, look what happens to those options the next, 25 days. It's going to be painful for you. You could be sitting there looking at it like, why am I losing money? I'm getting the directionality right. Like it could be going in your right direction, but that theta would be offsetting it if you don't set it up correctly. All right. So Theta the Thief. One thing I want to talk about, you can see this show up in the platform here. I've got an old screenshot of SPY, but I want you to take a look at theta. Note that theta is always a negative number, right? Because you can't go back in time. I told you everything is an advancement. And if theta is a thief, every day it comes in and steals some premiums. But you can see way out here in time, it's much less than inside this 20 some odd days to expiration, right? So between 149 days to 86 days, look how much the theta increased. Not very much, 1 penny during that entire time. So it was pretty consistent there. And then you start going from 86 days to 58 days, right? That's right around 31 days. It only increased maybe 1.5 cents, right? This is going to be rounding, so it looks like 1 cent, but you can see this one's doubled. So it's probably 1.5 cents to 2 cents that it's increased. But then look what happens in the next 30 days. It's increased by about 50% there, right? So when the other one only increased by less than 10%, this one's increased by 50% in those next days. So if I was buying here, right, that's the kind of theta decay I would be getting. So that's why you would want to be selling, out in this area somewhere in 35, 45 days to expiration so that you get this big ramp up every single day. And, basically 2 or 3 days down the road, it's going to be another 2 cents added in there because of that cliff we were looking at. With our trade, though, I'm looking at a trade in Delta, right? And you heard me talk about why it's kind of gotten back to that middle of the range. There's a volume node there. They have high implied volatility. I think it's going to stay sideways. I need to look at something that is going to get that theta decay. And you can see that the theta going from, if I got involved in 51 days, that theta really didn't increase that much during the next 30 days. But these next just even 15 days, look what's happened to the theta decay. It's going to almost double in the next 15 days or less. Okay, 2 weeks. All right. So that's the type of scenario I want to get involved in because I have high implied volatility. I'm already leaning towards selling options, right? And if I'm selling options because of that high volatility, I expect it to come out. I want to sell high, buy low, take advantage of theta to boot. All right. And then when this underlying trades sideways, if it does, then I will be able to take advantage of that going forward. So if I've got a market neutral assumption with high implied volatility, one of the best trades for especially newer traders is the Iron Condor. If you want to get used to selling options and you're a newer trader, that means you probably don't have a lot of swing trade setups, right? Or haven't looked at a lot of candlestick setups to determine that. Well, this is a good one for when you're looking at it and saying, hey, I really just don't think that this thing's going anywhere. And those premiums are just so expensive that I got to take advantage of collection of credit. So we're going to be looking at the Iron Condor for that neutral market assumption. Now, with a neutral market assumption, that would be like if XYZ was trading right here, the price is zero, meaning that it just hasn't moved, right? So what we're going to look to do is define our risk at the 1 standard deviation. We could say this is the call side, and this is the put side because they're negative, right? So one standard deviation is a 16 delta, all right? And how do I get that? Basically, a standard deviation curve is the same thing as your probabilities of a move, right? Probability, if XYZ is right here, moving outside this way or outside of that way. I believe that this is where it's going to trade, right? I don't think it's going to go outside those extremes, all right? So I'm going to try and define my risk right around that 16 delta. That gives me about a 70% probability of it staying inside of that, all right? Pretty good chances of success with this trade. 70% is pretty darn good, all right? So when we're looking at this, we're going to be looking at delta, and it tells us the rate of change in that option. So when underlying moves up by $1, remember I said we aren't going to be able to take advantage of it dollar for dollar? Well, what we will do is when the underlying moves higher by $1, if it was in the calls, then our premiums would increase by the corresponding delta, all right? Just like volatility increase, our premiums increase. Well, on delta, the calls are positive, the puts are negative because it's assumed a move higher. And if the puts get further and further out of the money, then they're going to go down in value, right? So delta tells us that, but it also tells us the odds of success. So like I was just talking about, it's the same thing. The standard deviation curve tells you the probabilities of something happening. Well, delta tells us the same thing. The delta is basically correlated to standard deviations, all right, to the standard deviation curve. Something to note with that, though, we will have skew and stuff like that. And when volatility is normal, let's just say this is a normal volatility curve, right? Let me erase all of my ink on here because I'm going to ink it all up again. All right, so if this is a standard deviation curve, this would be under normal times, right? When volatility goes down, what we actually see happen is this standard deviation curve ends up squeezing higher like that, all right? Now, the probabilities of this happening are much, this might be, let's just say this is 100 strike, and the puts, let's just say this is a 80 strike, and then this strike up here, let's just say it's 120, all right? Now, this might be 110, 190, okay? Because volatilities come out. The probabilities of a big move are becoming much less. Now, if you can think of it like there's always a big bucket up here, and the volatility bucket's very low. But if the volatility bucket fills up, then what we see happen is this gets really stretched out, right? So this is 0, and now what we could see is this is 60, 100, 140, okay? Same standard deviations, but now this volatility bucket is full, right? This volatility bucket is basically halfway full, okay? I don't know if that analogy helps you. You don't pay much attention to the Vega on the option chains for the series and decide to buy or sell an option once you see what the IB is using the last 6 months on implied volatility study. Olina, what I do is I look at the Vega and I just know that that's implied volatility. I just know that it's just two names for the same thing. It's like your name's Jen or Jennifer. It's still the same thing, right? So volatility I do look at. And when volatility is at high for the last 6 months, then that's when I'm looking to sell. All right. I immediately know if volatility is high, I need to be collecting a credit. Because if volatility starts coming out and I bought it, then I could be directionally right and still lose money. And I actually have all kinds of videos out there where I've showed that happen for different trades. Now, those are cherry picked. They don't happen on any given day. But I do show how that works out. Does that answer your question, Alina? Yeah, we good? All right. So here's what we're going to be looking at. When we, I got a little ahead of myself. Here's what we're going to be looking at. The longs are right around that 16 delta. And this is, most people will just tell you you're selling an Iron Condor. They're not going to give you the strikes, folks. What they're going to do is just tell you, you sell a call spread and you sell a put spread is kind of what you're looking at here. There's your call spread and there's your put spread right above each other. You're just kind of sandwiching them. That creates the Iron Condor, two short option spreads. All right. So, and it's usually going to start out right around that 20 delta on the calls and the puts. Now, if we go and look at my trade here that I pulled, now I looked at this yesterday because I had that implied volatility yesterday. I was going through getting ready for this webinar. I usually set it up a day before. Well, I found this opportunity yesterday, and that's when the volatility was up there getting elevated. And I expected it to kind of settle down because of that setup there. So I started looking at as close to the 20 deltas I could to sell those calls and in the puts, right? And then I defined the risk by going out to around that 16 delta or as close as I could to that 16 delta, right? Now, the key here, though, is to collect. You want to collect your credit needs to equal at least a third the width of the spread. All right. And what does that mean? Well, keep this in mind. When we're doing an Iron Condor, we're trying to sandwich this underlying, right? I'm trying to sell a call spread up here and sell a put spread here. That means the underlying stays in between, right? So it can't go in both directions at one time. So only one side of this strategy can really hurt me, right? If it goes through the calls, then that call spread's the one that hurt me. The put spread's making money. So this is $1 wide. So on $1 wide, that's going to equal right around 33 cents, right? Which is literally what we did there. All right. Try to collect a third the width of the strike. So like on a $5 wide, you're going to be looking at trying to collect around $1. What is that? $1.80 or so. Okay. $10 wide, you're going to try and collect $3.33. All right. So that would be that third the width of the spread. So that is the key when you're collecting a credit here, is to get at least a third the width of the spread. Now, you can do an Iron Condor with really low volatility, folks, and still pick those same deltas, and it will probably work out to be a third the width of the spread. But what did you do wrong? You set it up with low volatility. That means when volatility is low, remember, we're getting those strikes closer and closer together, right? As that bell curve squeezes together, those strikes get closer and closer together, even though they're the same delta. Delta is just telling us the probability that those strikes will be in the money at expiration. And when volatility is going down, volatility is telling us that range isn't going to be as big. Okay? But when volatility is jacked up, it's saying, hey, we could go anywhere. The idea is when volatility is at extremes, you can take advantage of that because fear is overstated usually. Okay? And complacently is understated. Right? So we'd like to set it up like that. And then when do you get out? I say, especially on $1 wide one, folks, you're going to have to get out for about a nickel. Okay. So like on that trade that I just talked about, I'm getting 32 cents, collecting 32 cents. I'm going to try and buy it back for a nickel. And I'll put it in as soon as I get filled. I can put it in as a GTC or just keep an eye on it. But the other thing would be with this strategy, because it's defined risk on the Iron Condor, I'm going to let this one play out for a full winner or loser, okay? But get out for 70, any other trade, get out for 75% max profit, all right? And what's max profit on a trade where you're collecting a credit? The credit is your max profit, okay? Except the butterflies are a little bit different, but we'll talk about those later. But when you collect a credit, that's your max profit, okay? Most times when you collect a credit, that's your max profit, all right? Your max loss is the width of the spread, which in our case was $1. That's my max loss minus that credit. Because if you collect a credit, you always get to keep that, folks. All right. If you collect a credit, you always get to keep it. Even if I shorted a call, like that one example where we were talking about selling that 105 call, I still get to keep that credit despite the fact that my stock got called away from me at 105. Whatever credit is still mine. All right. So with this one, your max profit is a credit. The max loss is the width of the spread minus that credit. All right. Your thoughts on adjusting or by rolling the unchallenged side? Ron, that is a great question. And I applaud you for bringing that up because I was going to forget about talking about that. Yes, roll it up because you can roll it up and create an iron butterfly. I wouldn't go any further than the short strike of the call. So in this case, what Ron's asking here is if this underlying, let me get rid of my pen, my ink. What he's saying here is what happens, we're right here, right, on these. What happens if, or sorry, this one and this one, the 38, the 45. So if this underlying starts going up, and let's just say we're trading around 40, 44, okay? That's when you're going to be getting a little bit nervous. The underlying goes up to $44. So what happens is this spread is going to start losing money, right? The closer and closer I get to that short strike, it's going to start increasing in value. I'm going to lose money on this. What Ron brought up is, what do you do about this put spread down here? It's probably going to be worth 0. So it's not helping. All really that can happen is the underlying goes back down there and it hurt you. So one thing you can do, Ron, is take off that put spread completely for 0. All right. The Iron Condor is one of the few strategies that I will play around with and stay mechanical with. All right. Covered calls and there's other ones that I will, but like a short put spread, I'm not going to probably adjust. All right. A long call spread, I'm probably not going to adjust. But this one, definitely, because I can move this put spread. If it's trading 44, I can move it all the way up to the 44 strike and make it a 44, 43. So then I would have a really tight Iron Condor, right? If it landed right around 44.50, that would be the thing where I got to collect all of it. So what we're trying to do here is collect a little bit more credit so that if it continues to shoot through to the upside, I've minimized my overall max loss, right? Because if I collect another credit, I get to keep those credits. So all of those little credits start adding up, all right? So if I collected another, let's say 50 cents for rolling this strategy up, right? Then my overall collection would be 83 cents. Does that make sense for everybody? Because this put spread, if I roll it up and I collected maybe 50 cents for it at that time, because I would be getting very aggressive, then that overall credit is what I got to take into account for my overall profit and loss. Okay. So if you continue to collect another credit, then that adds into lowering your overall risk, right? Does that make sense? Great question, Ron. I'm glad you brought that up because I wasn't even thinking along those lines earlier today. So here is what it would look like on the Analyze tab, right? This is where you would make $333 or on a 10 lot. On this one, it's $33 I would make. And then on the max loss here would be basically $67 for every 1 lot. All right. If it stayed right here, that's when in between these, then that's when I'm going to make that max credit. All right. Oh, and one of the things with your break even is your short strike on the calls, short strike plus the credit. So you can see here, we got the short strike here is the 45 plus the credit of 32 cents is my break even to the upside. Now my break even to the downside is going to be that 38 strike minus the 32 32 cents, actually. I have 33 up here, 32 cents. So that's going to basically put my break even at 37. That's the break even right there. I got it lined up wrong. 37, what is it? 37.67. Okay. Is the break even to that downside. Now, remember when I was talking about the volatility coming out of it? Some of you guys are probably flipping through your own charts and already noticing this. But what happened today was, I guess I didn't take a screenshot of the chart today. Let's just do, I looked at Amazon for earnings. What are we looking at? Delta Airlines. So look what happened to volatility. Yet when we were looking at this yesterday, it was trading 50, right? Today it's gone down to 45. That's 5 percentage points, folks. 5 percentage points in that option montage that we were looking at is a pretty big deal, because remember, we got to look at that Vega coefficient, and we can see that here it's gone down actually 6 percentage points. So look what happens with volatility. 2 cents, and at the monies are a little bit more, but so 2 cents for every 1 percentage point down, right? So these options were being adjusted by that downtick. Even all of them were, all right? So it kind of helped me in some of them. It kind of hurt me in the other ones. Now, I sold the one closer to the at the monies are going to have more volatility coefficient. You can see that these at the monies are. So when I'm selling one at the 45, you can see my coefficients are different by 1, right? So the one I'm short is going down in value faster, right? By 1 percentage point. So I basically, on this strategy, right, I'm gaining 1 penny for every downtick. So basically this strategy on the put side got better by 6 cents, right? In theory. Well, we can see the same strikes. It's now a 22-cent credit. Look at this underline. It's trading exactly where we talked about the day before. This was the day before when I was setting up the trade, and you can see it's trading right around that same price, 41.37. I can't find where my my actual chart is here. Let me try and go further. I can't see. Hold on. Give me 1 second, folks. Sorry. Where's the chart on this thing? Did I not have another chart? Where is it? There we go. After all that, I kind of forgot what I was talking about here. The volatility coming out. I need to see the chart from today. So those 6 percentage points. I'm sorry, folks. I kind of lost my train of thought of where I was going with that conversation. On that, what was I trying to say? So just that volatility coming out is all I can think about right now. The underlying, that's what I was trying to go to, is the price. That's what I was trying to figure out. This price, 41.35. This was the previous day, right? You can see it show up here. 23 days to expiration. We should be at 22 days to expiration here. And you can see that 22. So 1 day came by, that volatility came out, and my strategy got better by 10 cents, and the underlying didn't really move at all. All right. So that's why we try to set these things up with the volatility in our favor and all these levered and pulleys and working in our favor, because the theta helped me out, volatility helped me out, just in one night. If the volatility were low, then you would be buying an Iron Condor as opposed to going short. Yes, I would be inclined. Now, if I'm doing a long Iron Condor, though, a long Iron Condor is a very outpaced move, right? So I would be looking for an exceptionally large outpaced move, okay? So yes, in that case, when I'm buying, I'm actually expecting that bigger move, or the volatility just expanding, right? This underlying could, like, say for instance, the underlying was kind of trading like this. It could just start doing this and that volatility were increased, it didn't really go anywhere, and it might still be within your short strikes. It might come up there and, bump up against your short strike or the put side or the call side, but ultimately once it starts settling down there, that volatility will come out, right? And this would jack, if you expected this to start happening, then that would increase the volatility. If it went from, the tight range to jacking like that, you could still have on a long Iron Condor, and that would do well. As that volatility just expands, those premiums would go up. Does that make sense? But only, so if I were going to do a long Iron Condor, my thought process going into it is like, it's ready to pop or drop. I don't know where it's going to go, but it's ready to pop or drop. Okay. That makes sense? Anybody else have any other questions before we get moving on? So this was just, a great example of just when this volatility starts decreasing and the underlying stays the same, how you can make money with this strategy is really what I want you to take away from this. You want just overnight, one night, it's up $10. And that's because of the way we set this up, right? Now, had I done a different strategy, had I done the long Iron Condor and this volatility came out, you could see that I would be already hurting, right? As that volatility. That's why you want to set it up with all of the levers and pulleys I'm talking about. Think about it from, a logical standpoint, right? When volatility is extremely high, you just have to be thinking, it's so expensive, I have to sell it, right? Or when volatility is way low, it's just like, yeah, it can go lower or it could go higher, but the likelihood is that it wants to revert back to the mean. That's what usually will happen, all right? And then that way, like this is, moving back to the mean, I'm able to take advantage of just the premiums coming out of with the volatility, okay? I don't have to be smarter than everybody else. I don't have to pick the right direction all the time. Sometimes I can pick the wrong direction. As long as I've done the options correctly, that's all we can do is set ourselves up for success when we are implementing the strategy. All right, folks, that's all I got for you. Other than if you guys want to take advantage of this options course, we'll throw it over there in the chat window for you so you can take advantage of it over there, if I can find it. If you're watching it on tape delay or something else, you can put it, I'll put it over there in the chat window so you can just click on the hot link over there. But other than that, you're going to get all kinds of stuff for $36, folks. You're going to get well over 15 hours of content. I really dig into that market profile and how to trade around that when it gets to extremes, how you can take advantage of that. And when it, is at lower level or right there at the point of control, we can implement a strategy like what we just did in this Iron Condor. Let's see if I can throw this over there like this. I think that link goes out. And I believe it's a hot link for you. I can't click on it myself personally, but I believe that's over there in a hot link. All right, so we'll understand when, where, and why we are trading those options and why you would sell a call spread versus buying a put spread, all right? Those simple concepts, and then we'll build into real life examples like that, all right? And that's all I got. It'll bring you to a page, looks very similar to this page. I'm clicking on the wrong one again. It's going to bring you to this page here, all right? So this is basically a more detailed representation of what you're going to get on all of that. And this is actually a really great one, the history of options. Aristotle wrote about the first option trade. All right. Thank you guys all. Later webinars, I'll drill down on different option components, when and where I can find those. Make sure you hit the subscribe button, and there's a little bell right there to get you a notification if I pop on live at any given time. During earnings season, I'm going to be doing that quite often, talking about my trades that I do. Mornings, I usually talk about those early morning trades I try to set up for the week and or for that the rest of that duration. But the earnings trades are quick hits. I come in, talk about them right before the close, put those trades on right before the earnings, and then I'll talk about them the next day. All right, so check that out. And smash that like button for me if you would. It really does help. Finally, if you can't take that, Take it easy. Bye for now. Thank y'all.